Let's see. Okay, folks. The clock is ticking. Right? So somebody remind me again, Nisha, what's due next Monday? The project is due by 5 p.m. next Monday, right? So if you haven't picked a company yet, got a lot of work to do, you know? But hopefully you've all picked a company, you've passed the angst of doing a discounted cash flow valuation, you're in the pricing part. Now, money losing company, the only advice I have for you is you're one of those young money losing companies, don't take today's numbers, plug them into regressions because you're going to get predictable values. Like what? You put negative margins, negative accounting returns, which is what they have right now, into an EV to sales regression, you're going to get sometimes a negative EV to sales ratio. So with those companies, my only suggestion is go forward. Take your own DCF. The numbers are all there, right? You got predicted margins in year 10, predicted revenues in year 10, predicted return on capital in year 10. Use forward numbers to get you over the hump of getting a predicted value. Yes.
How do you want us to make the group?
Like, what do you mean? I mean, it's as a what format? Yeah, basically, I'll set up just like, just like the DCF, I'll set up subject matter. And you will just email it to that particular mailbox. It's critical, especially in these last 3 weeks, that you follow the subject matter, because otherwise projects will be all over the place. I don't want you submitting them on Brightspace. It's a pain in the neck for me to download stuff and put it on. But piece of advice, no Excel spreadsheets, nothing needed in the final project. All you need is your report with your companies, your value pricing recommendation options, if applicable for your company. And as a PDF file, one file for the entire group, one person in the group gets picked to submit. So I don't get 4 of you in the same group submitting the same report 4 times. So coordinate among yourselves as to who's going to do it. My guess it'll happen sometime on Saturday or Sunday for most of you. I'm being realistic. For some of you, it might be Monday at 4:58. Whatever it is, find out whatever it's, have some plans in advance on how to do it. So today we're going to complete our discussion of real options. And I want to talk about 2 things, 2 applications we haven't talked about. One is to value financial flexibility as an option. Let's back up. Right? You've all taken a corporate finance class. I think it's called corporate finance, the undergraduates as well now, right? How do you come up with an optimal debt ratio for a company? What is the optimal debt ratio for a company? How do we define that? No. Want to try? What makes it optimal, Dean?
Decreases the WACC and minimizes WACC.
It minimizes the WACC. So optimal debt ratio is the one that yields the lowest WACC. So when a company is under-levered, it has too little debt, it has a cost of capital higher than the optimal. That's bad, right? But let's say the company pushes back and says, look, I want to preserve that excess debt capacity just in case a project of a lifetime comes along. That's an options argument. They're saying we're willing to give up a cost of capital that's 30 basis points higher because the benefits we get from this flexibility will worth more than 30 basis points a year. I'm going to give you a way of computing that number, but more important than the number itself is the implications that come out of it. So I'm going to take a company and think of financial flexibility as an option. Here's how it plays out. By preserving that excess debt capacity, by borrowing less than I can, what do I get? I get the capacity to borrow that money and take this once in a lifetime project when it comes along. So the payoff comes from the fact that I take a project with this huge net present value because I have excess capacity. So think of that as the upside. What's the downside? That project never comes along, in which case you end up with this higher cost of capital than you needed to, and you have nothing to show for it. I told you it's a difficult option to value, but I'm going to try anyway. So here's how I'm going to approach it. I'm going to take an example. One of the companies I use in my corporate finance class, and I've used for 5 editions now, is Disney. So I do everything with Disney that I know as I go through the class, it becomes my lab experiment. This is from my 1997 edition, the very first edition of the book. I came up with an optimal debt ratio for Disney of 40% debt, and the cost of capital is minimized at 11.64%. They're actually at 12.22% cost of capital and 18% debt ratio. They're under levered. So let's say Disney's management says, we know we're under levered, but we're going to choose to stay under levered because we want to preserve that debt capacity to do great stuff. So what does the great stuff have to be worth? More than 54 basis points a year, right? Because that's what you're giving up by being at this too high a cost of capital. So I'm going to try to put a number on how much financial flexibility is worth using the option pricing framework. So here's what I'm going to do. For the expected reinvestment needs, I'm going to look at how much Disney has as CapEx and working capital each year as a percentage of value. I want to scale things because I want to get as a percent of value. So in a typical year, net CapEx, working capital acquisitions works out to about 5.3% a year. If you look at the standard deviation, that number tends to jump around. Some years it's a much higher number, some years it's a much lower number. It's unpredictable. That's what's going to give the option value. That standard deviation is 0.375. What Disney can actually raise from its traditional use of debt and internal equity is about 4.8%. So that's what they can get from their cash flows. And I'm going to value this option as a 1-year option. Why? Because I want to see whether I get more than that 58 basis points that I'm paying as a higher cost of capital. Trust me on this one, but if you work through the numbers, I get up a value of about 0.85% of value. The financial flexibility is worth 85 basis points, and I'm giving up only 58 basis points to get it. So what's the bottom line? When Disney says we're under levered, we're going to stay under levered because we value financial flexibility. I'm going to look at the numbers and say, you're right, you should stay under levered because you do need to value flexibility. It's a very difficult option to value, but I think the implications of just trying it once are useful. Here's what I can make as a generalization about financial flexibility, given that option argument. First, companies that are capital constrained should value financial flexibility more than companies that are less capital constrained. Imagine living in a world where you could raise as much capital as you wanted. You don't need financial flexibility, right? Great project comes along, you go raise capital. Who needs flexibility? The more capital constrained you are, the more you will value financial flexibility, which means you're more likely to be under levered if you're capital constrained. I would expect small companies to value financial flexibility more than big companies. Why? Because small companies are more capital constrained. I would expect privately owned businesses to value financial flexibility more than publicly traded companies. I would expect emerging market companies to value financial flexibility more than developed market companies. So capital constraints play a big role. Here's the second factor. Why do you need this financial flexibility? To meet that unpredictable reinvestment in the future, right? Keyword is unpredictable. If you have predictable reinvestment needs, you're an infrastructure company, you know exactly what you need to invest for the next 10 years, you don't need financial flexibility. You can line up the financing right now. The more unpredictable your reinvestment needs become, the more you're going to value financial flexibility. I'm not surprised when I see tech companies being among the most under-levered companies in the market. Why? Technology is much more unpredictable than utilities are. So when you look at companies, the unpredictability of reinvestment need kicks in. And here's a final factor. Why are we preserving this excess debt capacity? To take projects, right? But what if you're in a business where a typical project earns the cost of capital? There's zero value to flexibility there. So if you're in the steel business, in the automobile business, don't even talk to me about financial flexibility. I'm not interested in listening to it because there is no value added to expect. You're a software company and you want to talk about financial flexibility, I'm willing to listen. So as you look across companies, there are some companies which will be under-levered that you're just going to let go and say, that's okay. Other companies that are under-levered, we're going to push and say, you need to borrow more. Your financial flexibility argument falls flat. And again, it's not the numbers from the option pricing, but the implications that you take on. Which brings me to my last application of options. And ironically, it's the application that is most likely to find use when you value a company. Let's say you buy Con Ed, the company. What's the big reason investors have for buying Con Ed? It's not for price appreciation. It's not going to double in price. It's a big dividend paying stock. You buy it for the dividends. If you buy, in contrast, Microsoft, why would people be interested in buying Microsoft now? It's one of the best performing stocks this year. Growth, the AI story, it's because you think its value is going concern. Look, Chris, if you bought Bed Bath & Beyond, why would you buy Bed Bath & Beyond? It's definitely not for the dividends, right? It's not for the cash flows. You're buying it for the same reasons you buy a deep out of the money option, right? You buy it on a hope and a prayer. You hope that something good will happen, then you pray that something good will happen. Most of the time, what happens? Nothing good happens. But maybe that one time out of 100 when something good happens, it'll pop. You're buying it as an option. Equity in a publicly traded company takes on the characteristic of call option because of two properties that equity has. One is equity is a residual claim. Could somebody explain to me what that means? Dean, what does that mean? Residual.
You get paid last after.
In a typical normal year, after everybody else gets paid, you get whatever's left. And if in liquidation, you get whatever's left after every other claim order. It's a residual claim. The second feature of equity is it has limited liability. Yuki, what does that mean? Limited liability. Now it's what's the most you can lose. You buy shares in whatever you paid for the stock. And thank God for that, right? You hit zero and said, please God, don't let it go any further. And with equity, you're lucky because after zero, the broker can't call. The price is now minus $45, bring in an extra 45. With a private business, you might have unlimited liability, which means they can come after your personal assets after your business. So equity has a residual claim and it has limited liability. I'm going to use those features to frame equity as a call option. So you're the equity investors in a company. Are you allowed to liquidate the company if you want to? No, you're the equity investors. You can get together. You can say, oh, we're liquidating the company. You liquidate the company. What happens? You sell the assets. You get the value of the firm. You pay off the debt. Remember, that's not an obligation you can escape. And whatever is left over is yours. So you get that difference. What happens? The value of the firm is less than the face value of the debt. Well, you lose whatever you paid for the equity. There's a limit. That looks like a call option to me. So I'm going to construct a very simplistic example, but this example is going to allow me to extract all kinds of insights about both corporate finance and valuation. So here you have a company. I value the company, the entire company. The value of the company is 100 million, but I'm uncertain about the future. So the standard deviation of that value is 40%. Could be much higher, much lower. This company has one nice zero coupon bond outstanding with a 10-year maturity and an $80 million face value. In a second, I'm going to ask you why I made this a zero coupon bond and a 10-year maturity. But basically, I have one 10-year zero coupon bond with an $80 million face value. The 10-year bond rate is 10%. So I've given you the value of the company. I've given you the standard deviation of that value. I've given you the debt that's outstanding. And the interest, the 10-year T-bond rate. I'm going to argue that very limited information, you should be able to tell me what the value of the equity in this company is worth and what interest rate you would charge on the debt. I haven't given you cash flows. I haven't given you betas, cost of debt, none of that. Here's how I'm going to do it. I'm going to structure the equity in this company as a call option. What is the underlying asset? It's the underlying business, $100 million business. That becomes the S in the model. So the S in the model is the discounted cash flow valuation of the operating assets you had for the company. The exercise price, if you decide to liquidate, you got to pay the bondholders. How much do you have to pay them? $80 million. That becomes the strike price. So you got $100 million S and $80 million K. How long do you get to run the company? Until the end of the 10th year. What happens at the end of the 10th year that might take the power out of your hands? What comes due? The debt comes due, at which point the lender can say, I'll shut you down. You don't get that choice. But for the next 9 years and 364 days, you're king of the castle. You can do whatever you want. Now, do you see why I made it a zero coupon bond? Because the regular coupon bond, every year there'd be an interest payment due. And if you can't make that payment, so for simplicity, we've made 10-year zero coupon bond. The variance in firm value, because I estimated the standard deviation to be 0.4, is 0.16, 0.4 squared. T-bond rate is 10%. So I've got all the inputs I need for an option pricing model. So I plug the numbers in, D1, D2, N of D1, N of D2. So that's pretty mechanical. I'm going to come back and ask you whether there's some meaning in the N of D2 in a second. But the value that I get for the call is 75.94. You're saying, what the heck does that even tell me? Remember, your equity in this company is a call option. Your equity is worth 75.94 million. The total value of the company is 100 million. 75.94 million comes from equity. The remaining 24.06 million has to be debt. The face value of the bond, remember, it's a zero coupon bond, is 80 million. It's worth 24.06 today. The interest rate I can back out from those numbers is 12.77%. As promised, I gave you a value for the equity, 75.94. I've told you what interest rate I'll be willing to pay on the debt, 12.77%. You circle back though. What does ND2? Do you remember what ND2 roughly tells me? What's a yes, Shishna? Property, so let's make it specific. You're right. It's property of, in this case, that S will be greater than K. S is the value of the firm is greater than my face value of debt. So there's a 63% chance that the value of the business is going to be greater than the debt that I owe, which means there's a 37% chance of what? What happens when the value of the debt is greater than the face value? The value of the debt is greater than the value of the firm. You're bankrupt. There's a 37% chance of bankruptcy. So let's summarize. With this company at $100 million valuation, the value of the equity is 75.94 million. The interest rate of the debt is 12.77%, and there's a 37% chance that this company will go bankrupt. There's an outfit on the West Coast called KMV. And what they do actually, if you take a loan portfolio or accompany them, they assess a probability of bankruptcy for the company. You know how they do it? They put it through an option pricing model. They take the N of D2, and 1 minus N of D2 becomes the likelihood that your company will go bankrupt. So everybody comfortable? 75.94 million is the equity. Let's suppose you listen to me, bad mistake, and buy the equity for 75.94. Tomorrow you wake up to some catastrophic news. Half the company has disappeared. How can that happen? You're one factory in Florida and one in California. You take your pick, a hurricane or an earthquake, one of the factories is gone, uninsured. So your value of the business has gone from 100 million to 50 million. As an equity investor, is this good news or bad news? You have a very perverse definition of good news. This is really bad news, right? Your equity is going to be worth a lot less. But I want to explore how much less. Do you see what I mean by that? It was 75.94 million before. Here are your three choices. I took half of the value, 50 million off. Maybe it'll drop to 25.94, 50 million. Maybe it'll drop by less than 50 million, in which case somebody else has to bear the remaining loss. Or maybe you listen to your accountants, they're probably going to give you a negative book equity and say this equity is worth nothing. Which do you think is the right choice? You think it'll drop by less than 50 million, about 50 million, or more than 50 million? Deep, you want to try? It'll drop by less than 50 million, in which case, who's the only other player in this game who's left holding the bag? The debt holders. Do they want to be part of this game? They say, no, I don't want to be part of this. No, you're dragged in, whether you like it or not. So let's say if that's true. So what I did was I took the option pricing model, lowered the value of the firm from 100 to 50 million. So 50 million My value of equity is going to reflect the other inputs in the model remain exactly the same. Same face value of debt, same life of the option. The value that I get for the equity is 30.44. Used to be 75.94. It's dropped by 45.5 million. The value of the debt dropped by 4.5 million. That's the sharing that the equity investors do on the way down. Say, come on in, you share the pain as well. In fact, once I got started on this process, I could not stop myself. Let me explain. I dropped the value from 100 to 50. Then I dropped it to 40, then to 30, then to 20. You know what I was trying to answer? When does equity become worthless in this company? And the answer was, I couldn't make equity go away. It's an incredibly stubborn instrument. I dropped the value of the business to 5 million. I dropped it to 3 million. Remember, it still owes 80 million. And the equity hung in there. So what's keeping equity afloat here? Go ahead. That's half of it. It's volatility and time. You have 10 years, 9, and what are you hoping? It's hope. I described as hope and a prayer. You're hoping that something good will happen. You're praying that something good will happen. Most of the time, nothing good will happen, but that hope and prayer keeps the value up. It gives me an it gives me an entirely different perspective on what bankruptcy actually means. Actually, my daughter, just turned 28 3 days ago, told me this when she was 3 years old. She's a financial genius, not really, but will act like she is. It was a summer where I was playing Monopoly with my 2 older sons, and she would insist on joining in. Very persistent little creature. So finally we let her in. And after the first game, I had to ban her because she was like a one-man Enron. You know how in Monopoly you take 200 every time you press go, she would take 200 whenever she felt like it. She'd put up hotels and properties that didn't belong to her, charge you when you went by. So finally I said, Kendra, you can't play this game anymore. You're done. Tiny person, horrible temper. She would start walking around and say, you're bankrupt, you're bankrupt, you're bankrupt. Very impressed that a three-year-old would know the word bankrupt. So I said, Kendra, what does bankrupt mean? Expecting an answer like the value of your outstanding liabilities. She said, bankrupt means you don't get to play the game anymore. You know what? That's a very insightful definition of bankruptcy, because as long as I get to play the game for 9 years and 364 days, I'm not bankrupt yet. That's what's keeping the equity afloat. The closer I get to the end of year 10, the closer to zero my value is. But as long as time is on my side, yeah. So if you're wondering who's buying Bed Bath & Beyond, you can actually buy shares in Bed Bath & Beyond still, even though it's in bankruptcy. You think who's doing it? It's people who are buying deep out of the money options. You know that you could have bought Continental Airlines. Now it's part of United in 1993 for 23 cents a share. 3 years later, those shares were worth $53 per share. 23 cents. You work out the percentage return. That's what you're hoping for. And it doesn't have to be 1 in 10. It only has to be 1 in 50 that takes off. It's a deep out of the money option. I'm going to use this to kind of illustrate another problem as well. In corporate finance, we talk about how incentives are different for equity investors as opposed to lenders. Now, to illustrate that danger of what happens when you're a lender to a company, I'm going to take the company we just valued before the catastrophe, 75.94 million in equity, 24.06 million debt value. The firm is 100 million. I'm going to play the role of a project salesperson. And I'm going to come to you with a project that I'm trying to sell. You ready? I walk into your office and say, I have a project for you. You're trained in corporate finance. You say, what's the net present value? I say, minus 2 million. You get ready to throw me out, right? I said, no, wait. Not only is negative net present value, it's a very risky project. This is going from bad to worse. So you want me to take a bad, very risky project. You know what? There might be a reason you might want to take this project. You're the equity investor. You're worth 75.94 million, right? You take this project. Let's see what happens in numbers. First, the $100 million value for the firm is going to become 98 million. Remember, net present values are additive. You take a minus $2 million project, the value of the firm drops. You say, there, I told you we shouldn't have done this. It's a risky project. So the 16% variance becomes 25.25. Basically, you've increased the standard deviation of the value. Do you remember what the value of your equity was before you took this bad project? 75.94. It's magic. I took a bad, risky project and your equity is now worth 77.71 million. Where's this magic happening from? Where did that additional value come from?
The volatility, right?
It's not, it's got to come out of somebody's pocket. Whose pocket have I just picked? I picked my debt holder's pocket. They're the ones effectively paying for not just the negative net present value, but for the added value. You know, the lesson you should take away from this, never lend to a highly levered company without getting protections, without being part of decisions, because otherwise you risk being taken to the cleaners. Because those equity, they're not being irrational, they're doing what's right for them. I've never understood why banks lend on LBOs as passive lenders. I've never understood how they get away with it. Makes no sense at all to me. To let KKR decide what's good for them and say, hey, we're going to go along for the ride. They're going on their ride, you might not be on that same ride. So interesting twist that you can see using the option pricing model. One final example. The conventional wisdom, we're going to talk about acquisitions today, is you pay fair value on a company. Your equity should be unaffected, like taking a zero net present value project. So let's say you go out and you acquire another company for 150 million. The fair value is 150 million. You're paying fair value. And I ask you, what will happen to your, remember your equity value was 75.94 before you did this? So what will happen to your value? Based on traditional corporate, the answer most people give is nothing should happen. It's a fair value acquisition. Let's say that's true. There's your company, right? That's a company you're acquiring. You're paying fair value. But here's what you're not factoring in. Both companies are risky companies standing alone. But what happens if I combine two risky companies? Remember that when you did portfolio theory, that first step, you do a 2-asset portfolio. Variance of the first asset times weight squared of the first asset. Come on, you should remember this from foundations. Weight of the second asset squared times variance of the second asset. Plus, what's the last term? It's a covariance term, right? 2 times weight 1, weight 2 times covariance, which means that the standard deviation of the combined firm can actually be lower than the standard deviation of the individual firms. And in this case, that's what happens. You're saying, so what? You see the consequences for you as an equity investor? By combining two risky firms, you made a combined firm that's safe. If you look at the value of the equity, after this deal, even though it's a fair value deal, the value of the combined equity drops by 3 million. So what's happening here? Where's that 3 million going? Who's benefiting from this merger? Lenders. And tell me why it works out. If you're a lender to these two, you're lenders to both companies, why would lenders in both companies be happier after the merger than before the merger? It's safer, and you lent money at an interest rate that reflected the riskiness of those firms. So basically, you're charging an interest rate that reflects risky companies, and I've created a safer company. So if you're a manager in a company that is doing this is a classic conglomerate. You go buy companies and other businesses. The way you claw back this benefit is by either renegotiating the interest rate with lenders, but if they don't agree to that, you know what else you can do? Borrow more money as you do acquisition, so you can get that debt value back to yourself. So it's a good way to think about how these processes play out. So let's talk about applying this on a real company, because as I said, some of you have money losing companies with a lot of debt. You need both conditions. Do you see why? Because it's a liquidation option, and without the debt face value, you're not going to get the equity option to have any value. So let's say you have a money losing company with a lot of debt. He's looking at my example saying, how the heck am I going to take my company and make it fit these characteristics? Because it's the example I showed you is very simplistic. I gave you the value of the company. I gave you a standard deviation. I made it have one nice zero coupon bond due in 10 years. No trouble company ever fits those needs. So I'll give you the way in which I tried to make a real company squeeze through into my simplistic example. You asked me for a value of the firm. You know what I'm going to do? I'm going to go to my DCF valuation, look at the DCF value for my operating assets, and that's going to become the S in my model. So if I've done a discounted cash flow valuation already, I don't have to start from scratch. This option argument is an extension of a discounted cash flow valuation, not an alternative. So I start with the DCF value. You say, what if I haven't done a DCF value? I might do a pricing. based on revenues, EBITDA, something to come up with what would I get if I liquidated the company? That's my S. For my variance, I'm in trouble, right? Because I need a variance in firm value. If the shares and the bonds of this company are traded, I can again construct a variance in firm value by taking a weighted average, but I'm too lazy to do that. So I'm going to do what I did when we did betas. What did I say was the best way to estimate beta for your company? Look at the average set. I actually have bottom-up variances in firm value on my website for difference. So you have a troubled steel company, I give you a variance of a typical steel company. You have a troubled chemical company, I give you the variance of a typical, to use that. It's a much easier input and actually a better estimate than trying to build up to it from scratch. So I got the S, I've got the sigma. For the value of the debt, I'm going to cheat by taking all of your debt. You might have 15 different debt issues, adding them all together and treating it as if it were one gigantic zero coupon bond. It's not the way the world is, but I'm going to make it squeeze in there. And I'm going to take a weighted average of the durations if I can get them, but if I cannot, I'll take the weighted average maturity. So what I've done is taken all of your debt and replaced with one nice zero coupon. I'm home free. I can do an option pricing model. So let me try this out in a real company called Eurotunnel. Heard of it? It's a hole in the ground where cash goes in but never seems to come out, connecting England and France. It's been around a long time. It's a history of losing money. In fact, this was in 1997 when they lost 56 million pounds as operating losses and 685 million pounds as net losses, losing a lot of money. First condition met. In fact, they'd been losing money for so long, their book equity had turned negative. So first condition, money losing company, check that box. Do they have a lot of debt? Boy, do they have a lot of debt. 8.9 billion pounds in debt. A lot of it very long-term debt. It's an infrastructure company. So money losing company with a lot of debt. Looks like I should be able to apply option pricing. So first thing I did was I did a discounted cash flow valuation. That's why I said option pricing is not an alternative to DCF. So many of you already have the DCF value for your company. If you decide to do an option pricing, that becomes the S in the model. The value that I got for Eurotunnel, assuming it makes it back to health, was 2.3 billion pounds. Do you remember what it owed in the previous page? How much debt did it have? Almost 9 billion, right? This is with recovery, with margins improving, I get a value of 2.3 billion pounds, deep out of the money option. And for the variance, I actually computed the standard deviations, was able to get both Eurotunnel shares and bonds were traded. I wish I could have found an industry average, but in 1997, there weren't too many infrastructure companies who were publicly traded. So I computed the variance in firm value by taking the variance in stock prices, which is, standard deviation was 0.41. Standard deviation bond prices, and that last term, if it looks mysterious, is the covariance term. That's a variance in firm value. I've got everything I need to value Eurotunnel equity as an option. My S is my DCF value, 2.3 billion pounds. My K is my outstanding debt, 8.9 billion pounds. This is a deep out of the money option. The only saving grace is that debt is really long term. It's not due until 10.93 years. That's a weighted average duration. What I did was I took each individual debt issue, computed the duration of each one, took a weighted average. You could use a weighted average maturity if you know, clearly you can get away with it. And the variance is 0.0335. Remember what the probability of failure was in my hypothetical example, how I computed? Can somebody tell me what the likelihood that Eurotunnel will go bankrupt is based on the Black-Scholes model? What do I look at? 1 minus n of D2, there's a 92.5% chance that Eurotunnel will fail. That surprised me not in the least. But here's the magic. It's a deeply distressed company, right? It's never made money. Its book value of equity is negative. Your discounted cash flow valuation says this is the company in shambles. The value of the equity is 122 million bucks. What's keeping it afloat? Time and hope. Maybe the Sultan of Brunei will come in and say, I'll buy the tunnel and pay 5 times the value if you put my name on it. You can hope, right? You have 10.93 years to hope. When you think about deeply troubled companies, you basically have to stop thinking in traditional terms and think in very different terms. You have to think of it as an option. You see why that matters, right? If I ask you, would you buy a deeply troubled safe company or a deeply troubled risky company? Which one should you buy? I would always buy the risky one. You're buying an option now, right? You have to change everything. So this is called vulture investing. There are people who actually do it. They buy equities in deeply troubled companies. They might buy 50 different ones. Even the most successful vulture investors, 40 of the 50, you know what's going to happen to the equity? It's going to go to zero. The 10 that pay off or the 7 that pay off so big that they cover the remaining 42 or 43 and make more for them. It's a very different way of thinking about investing because risk is now your ally. You know what? If you're drowning, does it make a difference if you're drowning 12 feet of water or 16 feet of water? I think you're going to be dead either way, right? If you have deeply distressed equity, you know what you have, right? You have companies that are way below water. They're saying, you know what, I need risk as my ally to get above the water. So risk is your only chance of making it better. What if I thought if there are some sectors where I start with the default that I really am getting an option? I'll give you my favorite, the airline business, right? 90% of airlines, you're not buying a going concern, you're not buying a collection of dividends, you're buying an option. In fact, that's why last week's the valuation tools webcast used an Indian airline called Jet Airways at the when it had got in trouble and valued as an option. Air India, which is an Indian airline company going back in time, the oldest of the airline companies, recently got sold by the Indian government to the Tata Group for like a few $100 million. People look and say, why would you pay a few $100 million for an airline that is effectively bankrupt and losing money? They were buying an option. It changes your mindset. And that, I think, is the most useful thing that comes out of thinking about options in equity. Yes, go ahead, Asha.
So if we're looking take on a project that's negative, like negative and start companies probably equity, why do we discount cash flow statement? Like if we're getting lower than our cost of capital,
because there's enough transfer of wealth from the lenders for your equity investors to be worth more, right? So our measure for whether cash should be discounted is we're valuing the entire business. So this is about allocating value. My value for the business actually went down when I did this, but I gained because I stole from my bondholders. And it's a game under a game. So you're often looking at where the wealth transfer is coming from. So think about this, the applications we had. For most of you, you cannot try the pharma applications because you need details and patents that you cannot get. Natural resource applications are much more difficult to do because you can't get those undeveloped reserves, the kind of detail. But if you have a troubled company, you've had trouble getting that equity value to be greater than zero. Isha, for instance, has struggled all semester trying to get an equity value above zero, right? Your DCF value was zero, or it was actually negative, which is effectively zero. Your pricing, you're probably going to end up with the same zero value because the same factors are going to come in. This might be your only chance of getting, you got actually a positive number with your pricing. Congratulations, right? This might be your only chance of getting your number above zero. Is the only reason people are buying this company is because, one of the ways this option pays off is somebody acquires the company for some small piece of the company and pays a huge premium for it. That's what you're paying for. That's what the option pricing model is capturing. You need a lot of debt. Without the debt, you don't get the liquidation option because without it, you can't get that difference. So let's do one of the last two slides, which is acquisitions. About 20 years ago, a student of mine who graduated 10 years prior called me and he said, look, I'm running a seminar. His job was to run executive seminars for CEOs and CFOs. And he said, I'm running a seminar for CFOs of companies. And I said, I'm not interested in talking to them. I said, can I tell you more? He said, okay. And he said, these are CFOs of serial acquirers. Serial acquirers like a book of the month club. These companies do an acquisition of the month club. He said, I would like you to come in and talk to them. I said, you got the right, you sure you're talking to the right guy? You know what I think about acquisitions, right? He said, I do, but I would like you to come in and talk to them anyway, because for the rest of the day, they're going to hear from bankers. What do bankers think about acquisitions? It's the mother's milk of all deal making. This is the greatest thing on the face of the earth. He said, I'd like you to be the antidote. I said, okay, give me the last 45 minutes. So I showed up and I put this page up and it kind of captures what I think about acquisitions. It said, acquires anonymous, 7 steps back to sobriety. Because I'm convinced that acquisitions are an addiction. that once a company starts to grow through acquisitions, it doesn't want to go back to doing projects. Think of how much work it is to do 100 projects as opposed to one big acquisition, not to mention the egos, stroking you get when you do a big acquisition. Your name's in the Wall Street Journal, the CEO of the acquiring company. So I'm going to give you my very dyspeptic view of what I think about acquisitions. Before I do that, I want to get a sense of how many of you are graduating and going to work in an M&A department at an investment bank? Nobody wants to admit to it. Maybe after this session, none of you will want to go work there, or maybe everybody will want to work there. But let me start by laying out my foundation for why I am so negative about acquisitions. We all know when acquisitions hit the news, right? You get a news story, so-and-so is acquiring so-and-so, and often the focus is on the target company. But I would suggest you look at the acquiring company as well, because you see two very different stories play out. On the date the acquisition is announced, the target company stock price jumps. Why? It's good news, right? No target company shareholders ever said this, oh my God, my company is being acquired. I feel terrible. I feel great. Why? Because people are paying a premium for your shares. Like one of the interesting things is there's a jump on the acquisition day, but there tends to be a drift in the days before, which tells us what? Either remarkably perceptive markets or somebody's leaking information somewhere, right? So there's clearly leakage going on. We won't know from what's causing it. But target company shareholders are clearly the winners. What about acquiring company shareholders? They may, and then it gets worse than may. Basically, there's not much happening. And then after, as the acquisition is announced, the price starts to drift down. If you look at the percentages, they look disproportionate. There's a 25% jump in the target company, only a 2% drop in the acquiring company. But what are you not factoring in when you just compare those numbers? The typical acquiring company, somebody said scale, typical acquiring company is usually much, much bigger than the typical target company. On the day that Microsoft announced it was buying Activision, Activision stock price obviously jumped 35%. Microsoft stock price dropped by only 3%, but then you got to factor in that Microsoft is a $2 billion company and Activision is a $75 billion company. That's very, that almost looks like a wash, that whatever you saw in Activision came out of Microsoft's value. So on the day of the acquisition, clearly, if you ask the acquiring company shareholders, CFOs, why are you doing this? This is not creating value for us. You know what the response is going to be, right? You haven't seen what we've seen, which is what we've made forecasts of synergy as far as the eye can see. They're big numbers. You don't have access to that. That's why you're being so negative. Let's give them the benefit of the doubt. If that were the case, when you track acquisition the years after the acquisition, what should you see? Good stuff happening, right? Acquiring companies should get richer, more profitable, earn high returns because all that synergy that the bankers showed is starting to show up. McKinsey and KPMG have over the last 4 years asked this question repeatedly. So they go in 5 years after a merger. McKinsey would ask two basic questions. Does the return on invested capital in this acquisition exceed the cost of capital? That sounds familiar. It's a question we ask about any project. And then they ask, do parent companies actually do better after acquisitions relative to their peer group than before? Because synergy is paying off. You should have higher margins, higher returns. And the answer is no to both questions in most mergers. KPMG actually asked a different question. They looked at 9,000 mergers around the world and asked a singular question. What's a word that you see show up in merger after merger, the big word that explains away the premium? Synergy. They said, how often does synergy actually show up at companies? They found that in 1 in 6 cases, out of every 9,000, 1 in 6 cases, synergy shows up. In 2 to 3 out of 6, there's no synergy. And in about 2 out of 6, there's actually negative synergy. What does that mean? 2 companies come together. The combined company actually gets less profitable than the 2 companies coming together. So there's no evidence that acquisitions pay off on the date it's announced. There's no evidence if you track through time that they pay off. In fact, half of all mergers are reversed within 10 years of being done because they don't work out. So the collective evidence on acquisitions is not a good one. Until about 20 years ago, all of this evidence came from looking at US companies, because that's where the data was. And until about 20 years ago, if you look at an acquiring company and a target company, the acquiring company usually came from a developed market, US, Europe, and the target company was usually from an emerging market, right? You bought an Indian company or a Chinese company. Well, the worm has turned. Now, Indian companies are now in a position to be acquirers of UK companies and US companies. And one of the most painful things to see is the same phenomena you saw with US companies is playing out in every single other market. This is not just a US-centric problem of people overpaying. This seems to be a problem with acquisitions. This is actually from a study of Indian companies that do acquisitions and the acquiring company. There's actually an interesting result. Around the day of the acquisition of the months, the stock price actually goes up. It's almost like a patriotic fervor kicks in. So finally, an Indian company is taking over a US company. Let's push the price up. And then the hangover kicks in saying that wasn't good. So by 24 months after, you're saying, I wish they hadn't done that. Right. What I'm trying to say is this is a problem globally. It occurs across time, it occurs across different markets, which tells me that there's something wrong with the process. Because it can't be something that's easy, that's fixable, because by this time it should have been fixed. So there's no, if you look at the collective evidence, it acquires overpay and acquisition, that what they perceive in value of synergy doesn't often show up and say, why don't they fix it? I think part of the problem is in the process. We've talked about what's wrong with the M&A process. Remind me again how the process plays out. I'm an acquiring company. I see a target company I'm interested. It's a friendly merger. So what do we do next? We go to a banker. The game is done. The bankers come in. What's your objective as a banker? What you want to get done? You want to get the deal done, right? Why? Because, and you can't, it's not because they're bad people, but because we've loaded the incentive structure. Because if one of the bankers comes to you and says, look, this is a bad deal, let's not do it. It's very honest of that banker, but what do you get out of it? Nothing. So what I'd like to do is actually take you through the 7 most common sins in acquisitions. So actually, when I did this in front of the CFOs of serial acquirers, I gave them a deal. None of them took me up on it. I said, look, I'm going to pass you through 7 tests. If you fail more than 2, can you please stop doing acquisitions? They wouldn't take it on, but no, you're welcome to take on the challenge. So I'm going to take you to the 7 sins. First is what I'm going to call risk transference. In a minute, you're going to see exactly what I mean when I describe the process. The second is what I call debt subsidies, where an acquiring firm subsidizes a target firm because the acquiring firm has access to cheap debt and a lot of debt. The third is control. Remember the 20% premium that I said bankers had? I'm going to give you the source of that 20% and why it's so dangerous to slap it onto every acquisition. Then I want to confront synergy. Clearly, it's a one big word in valuation. I know one of the first questions I ask CFOs and mergers is, can you value synergy? And they say, maybe, maybe not, it's subjective. I say, you paying in subjective dollars for this acquisition or objective dollars? The minute you pay a 25 billion premium, you lost that subjective, I can't make an estimate. Of course it can be valued. Then I want to talk about pricing in the context of acquisitions. How do we price companies? We find comparables, we pick a multiple, and we price a company, right? I'm going to argue that that process is particularly skewed in acquisitions by the way we pick comparables and the way we pick multiples. 6, I want to talk about how there's a version of what happened. Have you read Alice in Wonderland? Now, Alice wanders in the Queen's court, and the Queen says, verdict first, trial afterwards. Sometimes in acquisitions, you get that sensation that the decision has already been made before the process even gets started. And the decision is often made at the very top. No middle manager wakes up and says, let's go do an acquisition. The CEO has some dream in the middle of the night, and he wakes up and says, you know what, I want to do an acquisition. And then the process plays out. And there's a final component of acquisition that really bugs me. You're a manager of a company, you take a bad project, you lose 20 million, you get fired. You're a manager of a company, you do a terrible acquisition, you pay a $20 billion premium you shouldn't have, you get promoted. Don't ask me why this works out that way, but nobody ever seems to lose their job after bad acquisitions. So let's start this game by setting this page up. I'd like you to set this page up for yourself. And with each test, I'm going to take you through a test. I want you to be honest with yourself. You don't have to be honest with me and see if you pass the test. And if you fail more than 2, please don't go to M&A. Okay. So let's start the process up. I'm going to keep the numbers simple, so you don't need a calculator to do this. Let's suppose I come to you with a target company. So here's what the numbers look like. Revenues of 100 million, operating expenses of 80 million, operating income of 20 million. Taxes of 8 million, after tax operating income of 12 million. Let's keep things simple and assume that this company has 0 growth in perpetuity. How does it make life simple for you? What does it do? You don't need reinvestment. Your after tax operating income becomes your free cash flow to the firm. So you have 12 million in free cash flow to the firm. This company is all equity finance. I told you I was going to keep things simple, and the cost of equity is 20%. So your cost of capital is also 20%. You ready? Here's my first question. Forget about the acquisition. If I asked you to value this target company as a standalone company, what's the value you'd come up with the company? 60 million, right? 12 million divided by 0.2, 60 million. You know why I want you to have that base number? Because my job for the next 25 minutes is to convince you to pay more than 60 million. Come up with every trick in the book. I'm going to try to get you to pay a premium. So here's my first trick. I said, but you're a safe company. Your cost of equity is only 10%. You see where I'm going, right? What am I trying to get you to do? I'm trying to get you to use your 10% cost of equity to value the target company, in which case, what's the 60 million going to become? 120 million. And if you do that, first you've overpaid, but you've set yourself on a path to keep overpaying, right? Because now I know you're a sucker. So what do? I find every risky company I can. I'm going to come and say, look, it looks cheap. And it will look cheap to you because you apply a 10. This is how AT&T drove itself from being $100 billion company down to almost 0 before somebody woke up and said, we've got our objective mixed up. It's not to minimize value, it's to maximize value. We have to stop doing this. First rule in acquisitions is when you value a target company, keep the risk at the target company level. It's a discounted cash flow rule. The discount rate applied cash flows should reflect the risk in those cash flows, not the risk of the entity looking at those cash flows. I still remember about 20 years ago when GE was at its peak of its glory, right? This is right after the build-up Jack Welch days, the largest market cap company in the world. I got invited to Stamford, which is where their headquarters were, and said, can you come and talk to our divisional heads? I don't know what got into my head. I said, yes. I show up and there's like an amphitheater there with the divisional heads. And I go through, I did Acquirers Anonymous because GE was an acquisitive company. I get to this point and I say, should value a target company using its risk profile. Look around the room and everybody has a very sheepish look. And I say, what, you guys do this, right? He said, no, at GE, we use GE's cost of capital to value target companies. I said, why would you do something that stupid? They said, we're so big, they're so small. What difference does it make? I said, if you take a Krispy Kreme donut and cut into 24 pieces and eat all 24, how many calories do you think you'll get? It's really tiny pieces, right? But by the time you finish all 24, you're going to get the same number of calories as eating the whole damn thing. You do 24 small acquisitions, you screw up the same way in all 24. You add them all up, you get a Krispy Kreme acquisition, right? You just overpaid collectively. There is no excuse for using an acquiring company's cost of equity, but half of all acquisitions, I see acquiring companies' cost of equity being used to value target companies. Second step. So that didn't work on you because you were too sensible. You've taken valuation class. You said, no, I will use the target company's cost of equity. So I come to you from a different direction. I say, you know what? You have access to a lot of debt at really low cost. Let's say the after-tax cost of debt is only 4%. And you plan to use half of the capital, you plan to borrow money. You see where I'm trying to lead you, right? What's the cost of capital? It's a weighted average of your cost of equity and your cost of debt. Half your money is now going to come from debt. I know you're supposed to lever the cost of equity. Let's assume that, I'll let you get by that. 20% is from cost of equity is 20%. Half comes from equity. Half comes from debt at 4%. So my cost of capital is going to be what? It's going to be 12%, right down the middle. I discount the 12 million at 12%. I get 100 million. I told you I was going to try to get you to pay more than 60 million. So I'm now saying, look, because you have access to a lot of cheap debt and you have a lot of, why don't you use a 12% cost of capital? That sounds more reasonable, right? After all, you have access to cheap debt. What's wrong with doing that? What's wrong with taking your cost of debt as the acquiring company, your capacity to borrow money, and using that in the cost of capital? You're going to pay a premium of 40 million, right? To the target company shareholders. For what? Why? Where's that premium coming from? From the fact that you have a really high rating. How do you get it? By working 100 years and building a nice, safe company. You've given it away to some target company shareholders who had absolutely nothing to do with this. Render unto the target company shareholders that which is theirs and not a penny more. When you use your cost of debt and your capacity to borrow money to push down the cost of capital, you're in effect subsidizing the target company shareholders for something they had no role in creating. So in valuing a target firm, my advice is do not bring in the acquiring firm's capacity to borrow money or its cheap debt into the mix. You might still use it. I'm not saying you shouldn't use it, but don't bring it in valuing the target company because you're going to then pay a premium for something the target company shareholders had no role in creating. You're saying it's really making it really difficult for me to acquire a company. You're absolutely right. I'm trying to make it more difficult because you saw the end result of what happens when I make it too easy. You go to these acquisitions, you ruin value, and there's nothing I have to show for it as a shareholder. Stop 3. So the first 2 did not try. You're too savvy for me. I said, but in acquisitions, it's common practice to add a 20% premium to my value. 60 million is my value. 20%. It's called control premium. You say control of what? It's control premium. So where did that come from? Most of the time, the banker will not know the answer, but I'll fill in the detail as to where the 20% came from. It came from looking at all acquisitions on a database called Mergestat, which you actually have access to as a Stern student, which has every acquisition and taking the difference between the price paid on an acquisition versus the market price before the acquisition. It's the average premium paid. You say, what's wrong with using that? What goes into that premium? Some of it is for control, right? What else is in there? Synergy. What about stupidity? When you overpay for something, where does it go? It goes in the premium as well. So essentially, there's a stupidity component. You're saying everybody else is stupid. I'm going to be stupid as well. It's not a great strategy to create value over time. I've never understood how people can get away applying that 20% because it has to be company specific. You want to see an example of company specific control premium? The example I just showed you. Remember that 100 million revenues and 20 million in EBIT, 20%. Let's assume you think you can run the company more efficient. The existing management is just sloppy and inefficient. If I asked you to value a company with you running it, you're going to replace the 20% margin with a 30% margin. Your 12 million will become 18 million. Your 60 million will become 90 million in value. You see why nothing else is changing? You've added 30. That's your value of control. Should you pay the 30 million as your premium on the acquisition? If you did, what have you done? You've taken the 30 million value you're going to get with your hard work and given it away to the target company shareholders up front. How do you win at this game if you keep doing that? But the premium you see as a control premium should depend on how well or badly a company is run. Badly run companies, that premium can be much bigger. So when you think about these rules of thumb and valuation, everybody else does it. 20% premiums. Now dig a little deeper because there's a huge variation in premiums across companies. And then think about from your perspective, does it make sense in this acquisition to pay a premium in the first place? Perfectly managed and perfectly run, there should be no premium for control because the company already is well managed. In fact, in the next session, we'll actually get an expected value for control for any company. It's easy to do. It requires you value the company twice. Status quo, run differently, run by you. So that's a value of control, which brings us to that magical word synergy. I'll give you my definition of synergy. It's going to be very specific. And the reason I'm going to be specific is I think people use the word synergy to fit in whatever they want. To me, synergy is two companies coming together are able to do something as a combined company that they could not have done as standalone companies. Let me repeat that again. The essence of synergy is two companies coming together and doing something they could not have done as standalone companies. So to value synergy, I need to have it show up. Remember the proposition in the cash flows or in the discount rate. And I'll make a statement up front and try to back it up. Most synergies are cash flow synergies. There are very few synergies in publicly traded companies that show up in discount rates. Because you're two public companies coming together, there's very little argument you can make that somehow magically you can create a public company that has a lower cost of capital just because you combine two public companies. And here again, you'll have to confront the issue. After you valued synergy, you have to decide what share of that belongs to you. Because remember, you need both the acquiring and the target company to show up. It's silly to leave 100% of the target company shareholders because you contribute as much and sometimes more to this process than they do. So Microsoft is buying Activision because it believes that as a combined company, they can do better in the metaverse, whatever that means. Then there's going to be some component of Microsoft that you need for this to work, because otherwise Activision could have done it to itself. And if you're Microsoft, you need to negotiate for that share to remain with Microsoft shareholders. So let's talk about the different forms that synergy can take. And synergy can either be operating synergy or financial synergy. Let's do operating synergy first. The easiest operating synergy to value is economies of scale, cost savings. What kinds of mergers are you most likely to see cost savings or economies of scale? Mergers in the same business usually, right? When InBev, the global brewer, bought Modelo, the Mexican brewery company, one of the reasons they did it was they said, look, we are a global brewer, we have distribution systems, we can shut down Modelo's distribution system, we can replace them with ours. We have a huge marketing program. We can slip in Modelo's marketing in there. We'll cut costs. And we can use Modelo's products and give them a much bigger market as well because we have this global distribution system. But the cost savings essentially came almost instantaneously. They were able to cut costs almost 30% right after the merger. The reason it's easy to value, it's concrete, it's right there. It lowers your cost, it increases your profits, you flow through the cash flows, you're done. That's economies of scale. But let's talk about the mergers that show up in growth. First, it can be in the form of a higher return on capital you earn on your existing project. As a combined company, you're able to earn a 12% return on capital instead of a 10% return on capital. As a combined firm, you're stronger. It could be that you can reinvest more. A developed market brand name company buys an emerging market brand name company they can take more projects because both products now have a bigger market to cater to. It could also be a longer growth period because you combined as a company and become stronger competitively. Just don't let the antitrust guys know that this is the reason you're doing it, because they might stop you, right? Because that's their job, is to make sure that doesn't happen. But implicitly, there's some kind of argument. Do you see what I'm trying to do? I'm trying to take the word synergy and say, where in my valuation can I show this? The return on capital, the reinvestment rate, the growth rate, the cash flows, because ultimately it's got to show up there. Those are operating synergies. I would love to tell you that most synergies and mergers are operating synergies, but they're not. To me, I mean, when I look at mergers, about 70% of synergies and mergers are financial synergies. And the most common financial synergy is like I call it the Voldemort synergy, a synergy that should not be named. Don't talk about it. This is the reason. What am I talking about? Tax savings. If you're saying I'm doing this merger for tax savings, for God's sakes, talk about everything but taxes. Talk about AI. It has nothing to do with the merger, but AI seems to work. I asked ChatGPT about why I should do the merger. Give me lots of good reasons. Look at these 2 pages that it gave. And as an example, I think about 6 years ago, Pfizer announced they were going to merge with Allergan, which is a UK-based pharmaceutical company. Everybody knew it was all about taxes because in those days, US tax laws required that you pay US taxes on global income, and Pfizer did not want to do it. By merging with Allergan and becoming a UK-based company, you essentially shift tax codes. And everybody knew it. And the CEO of Pfizer gets on CNBC. And he must have been drunk, I think. A CNBC anchor asks him, well, why are you planning on doing this merger? And the CEO says, because we want to save on taxes. I remember hitting my head against the wall saying, what are you doing? Because you could see exactly what was going to happen after the CNBC interview. The IRS started saying, we will take a look at this merger. Senators start taking over the floor saying this is about saving taxes. 2 weeks later, the deal was dead. So if you're going to do a merger because you'll save on taxes, talk about strategic considerations, talk about China, talk about everything but taxes, hoping that nobody notices why you're really doing it. Saying, how am I going to save taxes in a merger? One is you're allowed to write up assets after a merger. In fact, this is the game that accountants do after a merger. They come in and they write up assets, and a higher book value allows you more depreciation, more tax benefits. And there are some countries where the tax code actually gives you a benefit from a merger. My favorite example is Brazil. Brazil, about 30 years ago, the Brazilian government decided that because the tax law was tilted towards that, how interest expense is deductible, they were going to try to make it fair by giving an equivalent tax deduction for equity. And the way it works in Brazil, it's called interest on capital, is you're allowed to take your book equity, and every year the government will give you a percentage number, 12%. So you take 12% of book equity, you're allowed to claim it as a tax deduction. You're saying, so what? What happens to your book equity after a merger? Usually goes up, right? Because in a sense, you bought a company for market value, you bring it into goodwill as an asset, but your book value of equity goes up. The day that Embev was acquired by this Belgian brewer called Embev, it's the heart of what's now the global company. 80% of the synergy from that merger came from writing up book values and the higher tax benefits. That's a financial benefit. You can have two companies which by themselves can't borrow much money because they're risky companies, but you combine them, they might be able to borrow money. How does that help you? Higher debt ratio, lower cost of capital, higher value. If a public company uses the argument that they're doing an acquisition just for diversification, what should you push back with? I can diversify. I've never paid a 30% premium. Have you guys paid a 30% premium? Go on Schwab online. So I'd like to pay a 30% premium. You pay at market price, right? When you do an acquisition, a company does it as pay 20, 25, 30% premium. If the only reason is diversification, I can do it much more cheaply than any company that I own shares. But there's one exception to the rule that diversification cannot be a good reason for a merger. Let's say you're the owner of a private business. What's a beta that we use to come up with your cost of equity? A total beta, right? What went into total beta? A market beta and a correlation with the market. That private business owner now goes and buys a second business in a second company in a different business. What should happen to the correlation of that combined company with the market? It should go up. As you start to diversify, the correlation should increase. If you look at family group companies, especially very old family group companies in Asia and Latin America, take a look at what businesses they're in. You know what you're going to very quickly find? They're in everything. But that's how they survive, because until about 40 years ago, before public markets, that's how family groups survived. You don't want to be a family group steel company. You want to be a family group in steel and chemicals and financial services. You create, in a sense, your own diversification within the company because you had no choice. So when somebody says there is synergy in the merger, what do you have to do? You have to ask them the question, what form, where will it show up? Because you've got to put that into the numbers. So I'm going to give you the 3-step process for computing the value of synergy. This is your counter to anybody who says, I cannot value synergy. First step, you value the acquiring company and the target company as standalone companies. Let me repeat again, you cannot value synergy by just looking at the target company. You've got to value the acquiring company and the target company as standalone companies. Step 2, just add the values that you got in step 1 together. What is that going to give me? It's going to give me the value of the combined company if there were no synergy. Step 3, throw everything but the kitchen sink into the say, I think this merger will cut costs, increase growth rate, reduce cost of capital. I'm going to put that all in. And in step 3, I'm going to value the combined company with all the synergies built in. So what should I get in step 3 as my combined company's value? A much higher number than I got in step 2 by just adding up the two values. That difference is the value of synergy. So I'm going to try this on the company. Yeah, from 20 years ago. Procter & Gamble, then the largest consumer product company in the world, acquired Gillette. The sixth largest, huge merger. And talk of synergy filled the air. So I decided I wanted to value synergy to see whether this was a good deal for Procter & Gamble shareholders. So I valued Procter & Gamble standing alone, came up with a value of 221 billion. Valued Gillette standing alone, came up with a value of 60 billion. So that's step one. You add the two numbers up, you get 281 billion. That's step two. That's the value of the company that you'd have got. I named the combined company Piglet. That's not the name they chose. Procter & Gamble, Gillette. They decided to stay with Procter & Gamble. Yeah. But let's call it Piglet to separate it from P&G before. So it's Piglet after. Piglet without synergy is worth 281 billion. And then I did a best case valuation of synergy. Let me explain why I call it best case. I took everything managers said they would do after the merger, assumed they would do it, and do it instantaneously, which almost never happens. So I gave them a higher growth rate. I assumed they'd cut costs by 250 million, came up with the value of the combined company with the synergy built in of 298 billion. There's a canard that in valuation, we don't think synergy has value. That's not true. I'm giving a $17 billion value to synergy. This is a good deal for Procter & Gamble shareholders. What have I not told you? How much they paid as a premium? They paid a $25 billion premium. And this is why acquisitions fail, is because people don't want to put numbers in synergy. They want to use it as a plug variable. That's why they want to leave it subjective and qualitative, because it'll expand to fill in whatever you pay. But if you, and this is a best case valuation. In fact, let me throw to you a few what ifs. What if I have to wait 3 years for the synergy to show up? After all, these are two big companies. It'll take a while for the synergy to show up. How would I bring that in? So 17 billion is my best case value, but if I have to wait 3 years to discount it back, now comes the tough question. Like, what discount rate? Who's getting the savings? The combined company, right? You'd use a combined company's cost of capital to discount back. 17 billion is going to become 14.5 billion. It's a very flexible technique. You can bring in whatever you want to bring in, but you have to factor it. Take a second example of synergy. Zenith at one time was one of the best known names in electronics in the US. You had Zenith TVs. By the time I did this, though, you know, the only asset Zenith had left, they'd accumulated a lot of losses. Kind of a sorry state for a company. We look how much we've accumulated there now. Well, so let's assume you're Best Buy and you're acquiring Zenith for one reason and one reason alone. You want those NOLs. $2 billion in NOLs. What's the cash flow benefit of getting an NOL? What is it? How does it help you? Pays less in taxes, right? So if you have a 36% tax rate, and this is how most bankers deal with NOLs, they multiply the tax rate by the NOL, which would give you $720 million in tax benefits. But that assumes you have 2 billion in taxable income right now to set the NOL against. Let's assume in this case that Best Buy has only 500 million in taxable income every year for the next 4 years. What is that going to do? You're still going to get the 720 million, but you're going to get 180 million every year for the next 4 years, right? How would I value it? You'd have to take a present value. You ready for the question? What discount rate should I use for that? What's the risk here? I gave you an expected operating income, right? Not a guaranteed operating income. If I gave you a guaranteed operating income, you could use the risk-free rate. But to the extent that operating income is uncertain, I'll have to discount those tax savings back. And that's effectively why you see me use NOLs carried into time in my DCF model. Is I don't allow you to take the tax benefit right away. I look to see when you make their income and I discount those tax benefits back to today at the cost of capital. So synergy can be valued because you're willing to pay for it. But because it's become a buzzword, people feel this urge to let's pay a premium. There's synergy here. Now look past the buzzwords, ask questions. And people are incredibly slippery. They do not want to be specific about synergy. But that's a red flag. Remember, I told you there are only 1 in 6 mergers in KPMG looked at had synergy. One of the common characteristics they noticed in these mergers is the planning for synergy happened before the merger was actually done. In other words, people had actually put down on paper what they did, and then somebody was held accountable for delivering on those numbers. Here's my advice to you. whenever you have these acquisitions, there's always somebody in the company who's pushing really hard for the acquisition. They want it to get done. They hire the bankers, they marshal them through the process. I would make that person responsible for delivering the numbers that I base the acquisition on. So, okay, you think there's a lot of synergy? We'll do it. But by the way, you are responsible for delivering. You'll be amazed at how quickly the numbers will come down to become more realistic when people realize, yeah, I'm supposed to deliver those numbers. Okay, let me be more realistic about it. So buzzwords are buzzwords, paying a premium for them is a recipe for disaster. Last step. Okay, enough time. We don't have enough time. Next session, we start, we'll talk about pricing in the context of synergies, and we'll talk about how to change value in a company. But keep working on your project, keep get your pricing done, and I will talk to you on Wednesday.
I just quick question about the grading of those. So. I did circle the one. I wanted to chat. Check 1, 2. Test, test.
Pretty slow, you over to capital markets finally. Realize it's being for. Yeah. I like. It's just kind of right. Like after. I do. It's. That's probably meant. Did you? Oh, it's going down. Yeah, personnel. Jerry's fine. Jerry told me last week. I love this week. Yeah. I didn't think that's the bad. Why, if you remember in the beginning of the go to the plan.
bad, I can't think of that.
No, I want. Hey, Roger.
The transmitter is on. I don't know if you can get the signal.
I see it. We have the signal.
Good? All right, he says good. Yeah. Making sure he's good. Do you hear? Do you see the audio meter, like a white meter going up?
Yeah.
How far? Oh, okay. No, right? Oh, there you go. There you go. So how's the volume here? How's the volume there? It's too much, yeah.
I can hear the
Check, check. Mic check. 1, 2, 1, 2. Check, check, check. Camera sounds good.
So what you can do is. I guess you could see it right now. Yeah. Yeah. And control it. I can make it easy for you. You can see it. You can make that. That over there.
person's gonna be sitting in the middle. Yeah, but we put a focus on the speaker, so Matt is gonna sit right there. The person who's talking is supposed to.
Right. Now let's do the camera settings. Did you do all the 1080 and everything?
Yeah, we'll put it.
Okay. Now. All set. Oh, okay. Thank you.
I'm sure.
I'll bring this back up to the cards.
Okay, I'll put the card back in the way.
I'll do that. Yeah, I'll do that.
No, you see that with all the weather. Yeah, I said it was.
You guys are welcome to hang here. Realize that I put it in the city. Three or eight? Five chairs. No, yeah. Ah, it's 5 people. 5 people. We can do the same. Okay, I mean, I'll just make it.
But good, I actually just got back from vacation. I took 2 weeks off to go get married, actually. Thank you. So I came back on Monday refreshed and energized and I still have that vacation energy. I think it's slowly.
Today's the first.
No, Monday.
Oh, no, last week.
But our next board meeting. Wait, what's today? Today's Monday. Yeah, so I would have, so next week, Thursday. We release the final regulations.
Yeah.
The social equity plan, licenses, and then.
Yeah, let's
All
do,
three,
let's do 1 through 5.
Right now, we're just trying to have.
The regulation on the separate.
We're trying to get last.
Batteries are good.
Last dish.
And then.
Want them up.
That's all we have. Yes.
Are they gonna be fine?
Yes.
One more round?
Well, we're not gonna.
Yeah.
We did all, we read 3,000 comments, incorporated a lot of them, so. Yeah, there were a lot of good equity comments. Yeah, once those are stamped, they got a 45-day period, then I'll stamp them at final, and we can start. Getting license applications, but then it starts for real after that, then we're like, basically just. Reviewing an issue license for forever after that, there's no more waiting and all that stuff to happen. Budget's like kind of a nightmare though. Very little clarity on what money we have, what we don't have.
Is that still true?
Yeah.
Yeah.
I mean, nobody's expecting us to generate our. They're just like, get sales going, if you gotta be some money. Trying to do that.
Right.
But, you know, it's sad because, say like a year from now, a year and a half, like the amount of money we're generating to invest in like we've run. Well, we need it now. Yeah.
Yeah, it's wild there. Yeah. We launched the data rights. Yeah. You can imagine from the perspective. And it's 3 days. There's something I do. It's a lot of.
Well, internally, we try to stay focused on the mission. And the MRT is very clear about what we're supposed to do, like we were supposed to select center. And so there's a lot of noise around what we're doing constantly, but like the last, I've been blue dispensary.
So it's gonna be the same sort of fire.
And the next one, bro, we just got going, you know, it's working. It's just not working the way everybody wants it. But yeah, we really gotta get some diversity. We'll have 300 hard lights that are like 75%. Like the moment of community. So now we need to get some grow. Yeah, I mean, you don't want to just be hemp farmer. I mean, that's already an issue because like a lot of that's where we're gonna open up in Harlem, like it's gonna be owned by Harlem natives, they'll want legacy Harlem brands on the shelf. Hemp farmers can't do that. So. But then like, the hemp farmers are also very incentive too, because they have enough stores and so. So like, even, you know, back in the day when it was about it. Farmers put it's not cool.
Right, right.
Like there's risk with going first, like the supply chain wasn't figured out yet. And a lot of where it was on. So. How does that sound to you, project going? They haven't started building today.
So, is it like, well,
Why not?
it's like, it's the business around. We both have big. Yeah, I mean, we talked together when we talked last. Maybe some. Why don't we take this?
Oh, really? Yeah. I mean,
And like, or is there? Still get there, but we just, yes. They understand.
After my.